Okay, so we've seen a little volatility in the stock market lately. It's been going up and down and up and down. And if somebody doesn't have a very long investment horizon, they might have a tendency to panic. What's going on? What should I do? I'm scared. And so after a relatively long run and a very, very good market since March 2020, things have just been going up, 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 up. And so what do you do when things are starting to get volatile, which is often happens toward the end of the year? It may not be because the economy is bad or that things are just going to keep on sliding forever. It's simply because a lot of people sell off toward the end of the year to pay for taxes, like Elon Musk did with his $11 billion tax bill and other things. So adjusting their portfolio, taking tax losses. So it's pretty normal toward the end of the year to see some fluctuation, and often it could be downward. So what do you do when things are going well? You invest in good companies with wide profit margins that have a track record of earnings growth, that have low debt, that are hard to compete with. That's what you do when things are going well. What do you do when things are going badly? Well, you hold on to good companies with little to no debt, with track records for earnings growth that are hard to compete with. And you buy more of it when it's going down. That's what you do. That's the right thing to do. And again, this is not investment advice. This is just my opinion. I'm just some guy on YouTube who's been investing for a lot of years and has done quite well. So this is my thinking. So the key thing is, what does Steve Jobs say? Steve Jobs says, you can't connect the dots looking forward. You can only connect them looking backward. So you can't connect the dots looking forward. Even Warren Buffett says, well, what's the future like? He said, well, the stock prices are going to go up and they're going to go down. I just can't tell you when. So the key thing is you buy good companies with wide profit margins and don't buy non-performing assets like Bitcoin just because it's gone up in the past doesn't mean it's going to go up in the future. We don't invest in greater fool theory investments, and we have a long-term investment horizon. So we look at things from a broad perspective. I mean, things like Bitcoin have gone down quite a bit in recent times. So non-performing assets, that's something we'll talk about. Don't invest in non-performing assets because if you look at a long-term track record, if your investment horizon, if you've only been investing for a year or two, you might think, wow, Bitcoin's just going to keep on going up because it's gone up for the last number of years. No, that doesn't necessarily mean that's going to happen. Just because it's gone up doesn't mean it's going to continue. Greater fools don't always show up that want to buy it for more than you paid for it. That's a greater fool theory type of investing. It's been really good. So those with short investment horizons, those people who are 25 years old who just got started, they may have a different perspective because they haven't seen the long term. I've seen long term, so I know what happens long term. So good companies with consecutive earnings growth, that's where we want to be. So let's go ahead and connect the dots looking backwards like Steve Jobs says. Let's go ahead and take a look at the iPad. You invest in good companies like Apple, Google, Microsoft, Facebook, Amazon, those kind of companies that have track records. And you buy them especially when things are going down and when they're below their line, when they're good deals. And just keep on investing, in those type of companies. Or an S&P 500 index fund. You can get that at Schwab or some other brokerage. You can get that index fund. So let's go ahead and take a look and get a little perspective from the iPad here. Here we go. So there we are. Okay, so let's take a look and see what happened in 2018. And I remember, when I was investing, then you can see what happened. Things went up, up, up here. See, up, up, up. And then all of a sudden, right toward the end of the year, pow! It just crashed. And you think the world is falling apart. I think that year the S&P 500 did about -5 or something around that neighborhood. So you think, oh my gosh, the world, it's crashing. What do I do? So what you do is you connect the dots looking backwards. You look at the history. So let's go ahead and do that. Let's look back a little bit further. Okay. So let's look back a little bit further. So that was. Here was 2018 where I just did this toward the end of the year, right? So it went crashing down, but look what happened. So the key thing is we keep our eyes on the man walking up the stairs, but not the yo-yo in his hand. I repeat, keep your eyes on the man walking up the stairs and not the yo-yo in his hand. That's the key thing to do. So see what happened. Let's see what happened when COVID hit. Bam! Wow! So what do? You panic sell? No. What do? You invest in good companies with track records, with little to no debt, with track records of earnings growth that are hard to compete with. That's what you do. That's what you do right here. You don't panic and sell, and but look what happened. Boom! Wow! If you would have just hung on, right, and you got somebody who sold it here and didn't buy back, they wouldn't have gotten this. But who knows that this is going to happen? So we buy more here. That's what I did. I bought more here, and look what happened. Boom! So hang on. So we got to look at have to look at the long-term trends in the stock market, so we don't do stupid things and panic. Right? Down is a direction too. Up is not the only direction the stock market does. So you just keep your money in good, strong companies with low debt. They have consecutive earnings growth, right? They have track records of earnings growth. And so let's see what happened here. This is the 2008-2009 world global financial crisis. See what happened here. Gosh, it was crazy during this time. Well, what do? You hang on, and eventually you get your money to grow. And so the people who panic when things are going down, they're going to lose and they don't get back in. Nobody knew the bottom was going to be here, right? So that's why market timing doesn't work too well, because people sell at the wrong time. They sell based on emotion rather than logic. So let's go ahead and keep on scrolling down here. So keep your money in good companies. Okay, this is the really backs out clear to the Great Depression, right? So the market had quite a run up here, right? Let me move my picture out of the way. There we go. So the market had quite a run up here, and then what happened when the market got overvalued and people panicked sold, boom, crashed. So this is from September of 1929 until May of 1932. It was just the whole time it was just nosediving and nosediving for that long extended period of time. Now, we have a little more control of the market now, so this is less likely to happen. I mean, the government with the interest rate controls and so on, this is not expected to happen again to this extreme, or for this amount of time. It's not expected because there's better controls now. But that's what happened, and look what happened here. Again, I believe this is back in the 1980s. There's another crash. So these gray parts are recessions here. See, recessions. But the key thing is look at the long-term perspective. If you would have bought here, boom. See if people who bought when COVID hit, boom, they're sitting pretty now. So the key thing is to take a look at the long-term perspective. Sit back when things are starting to crash. Sit back and take a look at the long-term perspective, and hold on for the long term in good companies. They're strong companies, and that's the secret. That's what you do, and you buy more of those good companies. You don't just panic sell. So the key thing is, down is a direction too for the stock market. It's not only up, like Warren Buffett says, only when the tide goes out do you discover who's been swimming naked, right? So those companies that have a lot of debt and have thin profit margins, well, those are the ones you don't want to put your money into. In 1913, there were 2,000 car companies, right? Now I got out of, I didn't invest in Rivian. That's one of the reasons I got out of Lucid Motors, because in 1913 there were 2,000 car companies, and now there are only 3. I mean, if you include Chrysler. So the key thing is we got to focus on companies with consecutive earnings growth. We've got to focus on strong companies that you do business with, right? If you have an Apple phone, you know if they're making good phones, or you know if their phones are junk. If you buy the next generation and it's junk, well, that's going to really affect the earnings, because that iPhone really contributes big time to their earnings. So that way you have your finger on the pulse there, and so that's the way to think. Don't panic, sit back, and take a look at the long view. Always look backwards to see what happens, because we can learn lessons from the past. So that's what to do when the market crash. Keep your perspective, maintain your composure, don't get freaked out, and don't let your emotions be your investment guide. Let the past, the lessons of the past be your investment guide. So I hope that helps. Hope that gives you a little perspective on what to do when the market crashes. And see you next time. Bye-bye.